Hi everybody, and welcome back to video 2 in chapter 5. Here, when we left off, we were looking at LIFO under perpetual inventory conditions. And here we have our recent costs are now going to be in cost of goods sold. And our oldest costs are going to remain in ending inventory. So let's see how that looks. Here is our original example, and this time, we're going to look how that's done using LIFO. So beginning balance, no different. We add our first purchase, no different. Here is our first cost of goods sold. Where do we get that? In LIFO, we work from the bottom up instead of the top down under FIFO. So we're going to take all of this 15 units. We need 5 more to make 20. So we're going to get 5 from this row here. And that leaves us 5 in ending inventory. We bring this row down to the start of the next band. We add this purchase. And now we bring this row down to the next band, this row down to the this row down to the next band, and bring this purchase across. Now, when we sell it, we're going to sell from the bottom up. So we'll take all of these 10 units. We need 23 total. So we'll take 13 out of this 20, and that leaves us 7 from this row here, and all of this 5 here. So our ending inventory is $1,260. Our cost of goods sold, $47.30. Again, we have to add these two to get $47.30. And in total, it's still $59.90. Okay. Weighted average. Weighted average, in this case, we assign an average cost to each unit of inventory. So basically, we take the cost of the goods available for sale from each sale and divide that through by the units on hand at the date of sale. So here is how we would do that. We're going to have, in the first period here, we're going to have $2,500, and we had 25 units. This 10, which we brought down to this row here, and this 15, which we brought over to here, total of 25. So that's 100. Now when we actually sell something, we're going to use this average cost at 20 units that we sell at $100, gives us $2,000. The remainder is in ending inventory. Okay? And so we keep going like that down the chart. So then we continue with our next purchase here. We bring this row down, we add this purchase here, we have another 25 units, this time a total of $2,800, so that's $112 per unit. We divide that by those 25 units, and we get 112 that way. So when we actually sell those beauties, which we do here, we're going to add it, so we need to bring this 25 units down at 112. You could bring them individually down, but we'll bring this total down here, add this 10 that we purchased on August 28th here, and that gives us a total of $39.90. We divide that by 35 units, we get an average of $114, and then we sell some at $114. So we sold 23 at $114. That gives us $26.22 added to this $2,000, gives us $46.22. And that leaves us with $13.68, 12 times 114, in our ending inventory. And again, the sum of $46.22 and $13.68, $59.90. Okay. Weighted average. That, I think, concludes that And I think you can see how weighted average works. Good examples there, I think, from McGraw-Hill. Now we'll take a look at analyzing the effects of those inventory methods on the financial and tax reporting. You'd be surprised to know that you can use FIFO for book and LIFO for tax, which most companies tend to want to do, which I'll explain here in a minute. Here in FIFO, our ending inventory is going to approximate current costs. LIFO, the cost of goods sold on the income statement, is going to approximate the current costs. Weighted average smooths out the price changes. I've done all three of those in my career, and I think I like weighted average the best. It makes analyzing the costs a little bit easier because it smooths out price changes, which may come to fruition because of some strange things. They may need to do a crash purchase, for example, because they miscalculated here and there as far as their planning. Okay, so now if we look at these in total, we see the different cost of goods sold here and the different associated gross profits. Now the sales are going to remain the same. So the gross profit here is going to be the lowest under FIFO or LIFO. And weighted average will always fall between LIFO and FIFO, which it does here. And so inventory is going to be higher under FIFO and lower under LIFO, and in between by weighted average. Specific identification just depends on what you actually sell at what particular cost. So, all right. The Internal Revenue Service requires that when LIFO is used for tax purposes, which it can be, it also must be used for financial reporting. This is called the LIFO conformity rule. All right. Now we'll take a look at lower of cost or market. This is fairly easy to understand, I think, and here's how we do it. We're defining the current replacement cost, not the sales price, consistent with the conservatism principle. And inventory has to be reported at a market value, when the market is lower than the cost. That happens every now and then. I use the iPhone as an example. How much would a iPhone 5 be worth right now? $50 or something like that? When it was sold, its cost may have been $200. So if Apple had any new iPhone 5s in its inventory, it would have to write that down to the lower of its cost, which in my example was $200, to $50 for every iPhone 5 that they might have. So we can, as I just did, we can apply that to the individual items or categories of assets or to the whole inventory in general. I have always used number one. All right, so here, a motorsport retailer has these inventories. Now you can see this Roadster cost is greater than what we can sell it for. But the cost of the Sprint is less than market. That's the normal condition. We obviously want to sell things for more than its cost. But I have to write down this Roadster inventory at $1,500 write-off for every one of those units. So $1,500 times 20 is going to be $140,000. We'll have to write down that inventory. But here, we're going to leave our costs alone for the Sprint. So when I write that down, that's going to be a write down of $40,000 or $30,000, and that $30,000 is 1,500 times 20. Okay, oops. And so when I do that, I write it off to cost of goods sold. We aren't actually selling anything here, so it is a little confusing that we charge it to cost of goods sold. But we are reducing merchandise inventory, and this is the best place to reflect those costs.